Welcome to The Truth About Taxes and Retirement. This podcast is brought to you by SavingYouTaxes.com and hosted by J. Barry Watts. As an advanced tax strategist and enrolled agent federally licensed by the IRS, Barry is uniquely qualified to go deeper into the Internal Revenue Code than most accountants. He understands and interprets its provisions, explaining how they'll help you reduce income taxes you owe so you can direct that previously wasted tax money into tax-free accounts that you can enjoy in your retirement years. Now, on today's episode.
Do you know what the difference is between tax avoidance and tax evasion? Jail! Here on The Truth About Taxes and Retirement, we want to avoid jail at all costs while taking advantage of every legal opportunity to avoid unnecessary taxes and reduce the amount you send to Washington, D.C. or your state capital. Hello, I'm J. Barry Watts, the host of The Truth About Taxes and Retirement. Alongside is my sidekick and producer, Patrice Sikora, and we're brought to you today by the WealthCare Corporation, found on the web at SavingYouTaxes.com. Hello, Patrice. Welcome to the show.
Well, hello. And one of these days, you're going to want me to say, here's Barry.
That could be cool if you could get that Tonight Show theme to go behind it. I might like that. I think go ahead. I'm sorry.
I was going to say it has to have the music. It can't just be me.
Da 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 da.
Here's Barry.
But that's not the music anymore. They've changed it. They got the roots, whatever the roots are. I don't know. How about a little Doc Severinsen? Did you know he's still alive?
I thought Are you sure he's still alive?
Well, now you're making me question myself. Why don't you Google that and see?
Right.
No, I think Doc is still
talking.
alive. He just turned like 93, 94 or something like that. I think he's the only one who's still there. And the interesting thing would be what percentage of our listeners actually know who Doc Severinsen is and recognized me humming the Tonight Show tune. Probably not most of them, if I were guessing.
It looks like he may still be around.
Yeah, I think I saw where he had
96.
a birthday.
96.
96. Oh, okay. I wonder if he still plays. That would be interesting.
Yeah, I hope so.
Can you still make music with your trumpet when you're 96 years old? Well, welcome.
As long as you have your teeth. As long as you have your teeth, right?
Is that what you got to have? I don't know. I thought it was all in the lips. Welcome to The Truth About Taxes and Retirement. I'm Barry Watts with Patrice Sikora, and we're going to be talking about all things tax today. But before we do that, Patrice is going to start the show with a little surprise for you. She's got something special for those of you who are interested in it. Patrice, tell us about it.
How about a free retirement toolkit?
Free is good.
Free is good. Retirement is always wonderful.
Retirement is good.
Toolkit.
Well, if you need to repair your retirement or need to build your retirement, tools are going to be necessary. So I think you're on the right path. Patrice, how do we get a free retirement toolkit?
All right. If you want this free retirement toolkit, all you have to do is go to wattswealth.com and you can download the toolkit. All right. That is Watts Wealth, WattsWealth.com. And again, there you can download this free toolkit. That sounds incredible. How do you download a toolkit?
Well, I think it's something special. I don't know. It's an internet thing. But if you click the buttons, you can get all the information about the tools you need to do some retirement planning that'll be helpful. So if they'll just go over to wattswealth.com, that will help them. And one of the things that you'll learn about in the toolkit are some strategies to reduce your taxes. And that's what we're going to talk about today, Patrice.
All right.
Nearly every one of our listeners qualifies for the present opportunity to reduce their taxes. But did you know that the majority of our listeners haven't touched this, even though they qualify? And the majority of them won't get the tax break that is written into the Internal Revenue Code because it's going to expire, Patrice, on December 31st, 2025.
That's not far away.
It isn't far away. In fact, that's only 2 years and 4 months or something like that. I guess we just gave away when this was recorded. So I can imagine somebody listening to this in 2 years and thinking that they have got 2 more years to go, and they don't have. December 31st, 2025 is when that will be. And so we want to help people figure out what this opportunity is and take advantage of this opportunity because we face a really big tax problem right around the corner. And we need to take advantage of every opportunity to protect ourselves from the nefarious solutions proposed by the Congress And the IRS, let's just collectively call them the government. Patrice, did you know that our government owes $32 trillion?
With a T.
Do you know how much $32 trillion is, Patrice?
It's not something I can win in the Mega Powerball?
No, that's a little too much. In fact, I'll help you get your brain around it a little better. $32 trillion is the equivalent of $32,000 billion. I like to say it that way, $32,000 billion, as if we knew what $1 billion was.
Yeah, it doesn't sound right, 32,000 billion.
No, but when I'm speaking to a large audience, I always say it that way, 32,000 billion, just because that causes you to stop and say, what did he say? And so you give it a little more thought than 32 trillion, because nobody knows what a trillion is. So I think it just blows right past them. Let me help you understand, Patrice, what $32,000 billion is that our government owes. That's $253,000 for every taxpayer. That means for my wife and me, that's $500,000 that we owe. Now, we just had a wedding in the family. My daughter Madison married Zach, and we love him. Madison and Zach owe $500,000 as well. And my missionary daughter Sydney, who makes not much over minimum wage, well, she owes $250,000, $253,000 as well. And so that's a problem that we're facing. Congressman Eric Burleson handed me a document that came right off of Kevin McCarthy's desk. And it said that by 2030, that's only 7 short years away, 6.5 actually now, the net interest that the government pays each year will exceed $1.4 trillion. Now, here's the problem with $1.4 trillion in interest. The total revenue of the federal government is only about $4 trillion. So over 30% of the government's current total revenue will be paid out in interest, not principal. They're not paying down your debt. Here's some more information for you. 50 cents out of every dollar the government borrows goes to pay interest. Interest costs between now and 2030 are going to total over $10 trillion. That would be a whole bunch of money.
A lot of money. Yeah.
And
but
eventually,
Barry, it's not fiscally possible.
Well, who said anything about fiscal?
Oh.
I think fiscality went out the door.
Mm-hmm.
We're just spending it because it's always somebody else's money. And I heard a guy on the radio today. I thought this was very interesting. He said if you add in the obligations of Medicare and Social Security, actually, instead of the debt being 32 trillion, he said it's like $150 trillion. That's a ship sinker.
Yeah.
So there's only one solution to it. And that one solution is to raise taxes. And it's really, Patrice, all because of a 4-letter word. Am I allowed to use 4-letter words on the broadcast?
Of course. It's a podcast.
So you won't bleep me out. There's no FCC on this. No. Well, all right, I'm going to give you the four-letter word. If children are listening, you may want to put in your ear pods or something. The 4-letter word is really simple. It's this: math. Math. M-A-T-H. Kids probably wanted you to put your earphones in for that, so they didn't hear it. The math says that the only possible way out of this is to raise taxes. So it is unquestionably going to happen. You are going to pay higher taxes in the future. Now, here's the problem, Patrice. You bought and were sold a bill of goods. 40 years ago, when you went to work, how'd you like that compliment I just paid you? 40 years ago, are you okay there? 40 years ago, when you
I did the math on that one.
They offered you 2 things, Patrice. They said, hey, there's this new thing called an IRA, an individual retirement account, and we're going to give you a 401k on top of that. And then they said, yeah, you got it. The pensions went away. And they told us if we'd put money into those things, they'd give us a tax break for your contribution. And Patrice said, what? I'm excited about that. Mm-hmm. And then they said, when you retire and start taking money out of that, you'll be in a lower tax bracket.
That was always the argument, wasn't it?
Yeah, that's the idea. So here's the question. How many of our listeners are actually in a lower tax bracket today than when they were in their 20s, their 30s, and their 40s? Virtually none of them. Occasionally, I'll have somebody in a public audience who'll say, well, I actually am in the lower tax bracket. But it's only one person who'll raise their hand out of a group of 50, generally speaking. Hardly anybody's in the lower tax bracket. And I'm not going to be in the lower tax bracket in retirement. And Patrice probably isn't in the lower tax bracket in retirement. And so here's the problem with those IRAs and 401ks that they sold you 40 years ago. They're fine tools for accumulating money, but they are terrible tools to retire with. Because any account on which you have to pay taxes in retirement is a problem. And the reason it's a problem is you don't get to control the tax rate and you don't get to control when you take the money out. That's all in control of someone else. So they issue rules and you have to abide by those rules or they punish you for not abiding by the rules. The first rule, Patrice, is the RMD rule. RMD stands for
required minimum distribution.
Well, it does. I was trying to think of something really funny first, but I couldn't get there.
Required minimum distribution is pretty funny to begin with.
It's funny. Well, it's pretty sad, I think.
It is.
That you're required. I thought this was America. We're not required to do anything. Well, except what do they say? Death and taxes.
That's right.
So those are the two requirements. So the required minimum distribution kicks in at age 73. It used to start at 70 and a half. They changed the law, said it starts at 72. Now the law says it starts at age 73. And this is the rule that says, hey, you're going to die someday, and we want to be sure that you get all your taxes paid before you die. So take your money out of your IRA and your 401k and pay all the taxes on it.
And we'll tell you how much you're going to be taking out of that requirement.
We will tell you. Yes, you don't get to do it on what your desire is. So when you reach that magic number, whether you need the money or not, the government forces you to take the money out of the account. They force you to pay the taxes on it at the rate they determine. And then whatever you take out of that account affects your Social Security, and they determine the rate at which it affects that. And it determines the tax you pay on Social Security, and the government determines the rate on that. And it counts in determining how much you pay on Medicare premiums, and the government controls that. This is a government scam. By the way, I sound like one of those radical radio guys who's always railing on the government. I kind of hate those guys. But they're true mostly. I don't want to be one of those people. I just want to be a person who puts it to you like it is. And I am telling you how it is. You're going to pay higher taxes in retirement, and you need to be prepared to deal with that. And the IRS is going to control when you have to pay those taxes and how much you have to pay in tax. And let's just say that you got $1 million in an IRA account. That'd be a decent IRA. It's not huge. You can't retire on that probably unless you live in a really pretty skinny place. But let's say you got $1 million in your IRA. In the first year, you are going to be required there at age 73 to withdraw approximately 3.9%. In the second year, you're going to have to take out 4.1%. In the third year, 4.3%. Patrice, are you seeing how this goes on and on and on?
It's going up and up and up and up.
It's going to go up every year for the rest of your life. And you can see the problem with that. You're having to withdraw more each year. Tax rates are rising. So your tax bill increases exponentially. That makes this what Ed Slott calls a massive ticking time bomb strapped to your retirement, and it's going to go boom. It causes your income to go up, which causes you to go into a higher tax bracket, which causes your tax rate to go up, which causes your Social Security tax to increase, which increases the premium you pay for Medicare. And as a result, when you're in your 80s, you're going to have less Social Security income and pay more for Medicare premiums than when you first retire. That's the bad news. But most, if not all, of that future tax, Patrice, is voluntary. It's voluntary.
Show me.
I'm going to walk you through how to begin protecting yourself from the rising tax problem in retirement. Let's go back. Let me show you the opportunity to save taxes. We'll start with 2017 because that was the year before the last time they changed the tax laws. In 2017, for purposes of our conversation, let's assume you were married and you filed jointly with your spouse and you had $100,000 in income. Now, the same rules are going to apply if you're single. It's just the numbers are slightly different. And here's the way this works. If you're making $100,000 a year, no matter how much money you make, we've got tax brackets. The code has brackets in it. So at certain levels, you fall into a different bracket. In 2017, if you made $100,000 a year, you fell into a bracket that ran from $75,000 to $150,000. I'm sorry, $153,000 actually. So you're at 100,000. You're halfway between that 75,000 bracket and that 153,000 bracket. And any income that falls into that bracket anywhere is taxed at 25%. For every dollar of income, 25 cents has to go to taxes. Now, the question, Patrice, is would you prefer, you answer this for us, would you prefer to pay taxes at a rate you know or at a rate that you don't know?
Yes.
Yes, which? Both?
No, I prefer to pay taxes at a rate I know.
Oh, okay. I just wanted to be sure and get that clear. Well, here's the question. Do you have it in writing what the IRS is going to tax you, what your rate will be when you're 75 or 80 or 85 years old?
Silly boy, of course not.
Hasn't come, has it?
Right.
And so we don't know what that future tax rate's going to be because they haven't even determined it yet. Well, they've determined it for some of us because that first tax increase is going to happen in just about 2.5 years there on December the 31st of 2025. So in 2017, if we made $100,000, remember the bracket started at 75,000, went all the way up to 153,000. If we made $100,000, how much room did we have left in the bracket that we could have earned more money and stayed in the same bracket?
Oh, 53,000.
$53,000. Now, think about this for a moment. I'm not very smart, just kind of an old country boy. If we know taxes are going higher than 25%, why would we not have taken that $53,000? Because we had $53,000 worth of room in that tax bracket. And we would have to pay 25% in tax. If we know taxes are going higher, why would we not have taken money from our retirement accounts at that cheap rate and paid the tax and put that money then over into an account where it would never, ever be taxed again?
Am I seeing a 4-letter word here?
Dumb? What is the 4-letter word?
ROTH?
Oh, well, yes, that is a 4-letter word too, because there are two types of accounts that are tax-free forever. One that you're perhaps familiar with that Patrice just pulled right out of her hat there is the Roth account. That's a tax-free account forever. There's another type of an account that is also tax-free, and that is permanent life insurance with accelerated death benefits that can be used to pay for long-term care. Now, we talked about those earlier in the spring when we did an episode of the podcast called Who Needs Insurance? Who Wants Insurance? And so if you didn't hear that episode, I would encourage you to go to savingyoutaxes.com and click on the resources there. You'll find the podcast episodes and listen to the podcast entitled Who Needs Insurance? Who Wants Insurance? And you'll learn all about how those life insurance policies with accelerated death benefit work, because that's one of the two ways that you can save and accumulate and grow money on a tax-free basis. So in 2017, you had room to convert $53,000 over to tax-free if you chose to do that. Most people didn't do that, but the rules changed on January 1st, 2018, because they passed something called the Tax Cuts and Jobs Act. Now, the $100,000 no longer falls in that bracket that started at $75,000 and goes to $153,000. The bracket changed. Now that $100,000 falls in the bracket between $89,000 and $190,000. So you could earn $90,000 additional dollars. And the reason I say earn is because if you take money out of your IRA account and move it over to a tax-free account, that money counts as earned income. It's taxed just like earned income. So if you're making $100,000, you could move $90,000 and still stay in the same tax bracket. And when they made that change in 2018 to those brackets, they also changed the tax rate. The tax rate fell from 25% to 22%. So every dollar gets taxed at 22%, 22 cents, instead of 25 cents. That's a 3-cent savings on every dollar. And some people say, well, I wouldn't stoop over to pick up 3 pennies. But I like the fact that those same people, when the local banks started offering CD rates above 3%, well, they almost had urinary incontinence. They were just so excited about it. So people are excited to have guaranteed 3%. This is a guaranteed 3%, but it's really not 3%. 25 to 22%. That's actually a 12% reduction in taxes. Now, I just have a question for you. If you got a 12% reduction in your grocery bill, would that be a good thing?
Oh, yes. Oh, yes.
Your utility bill?
Oh, yes.
Your cost of medicines at the pharmacy?
Oh, you're teasing me here.
12% on all of these different things. You've got a 12% offering, a 12% savings offer in taxes right there.
Mm-hmm.
But there's even better news. There's another tax bracket that I want you to look at for just a moment.
Wait, there's more?
There is more. In fact, there's always more, Patrice. We've just got so much time on the podcast. Better yet, there's another tax bracket with a different rate to look at. If your income falls between $190,000 and $364,000, $364,000. Now, remember, you were making $100,000, so now you've got $264,000 extra dollars. Then your tax is going to be only 24%. You could move $264,000 from your IRA over to a tax-free account, and you would only pay tax at the 24% rate. Remember when we started this conversation back in 2017 and we were only moving $53,000? The tax rate was 25%.
Right.
So if it was a good idea then, it's a great idea now.
And that's a lot of money you can move.
It is a lot of money. And Patrice, here's the big news. You could do it this year and next year and the next year. That's $750,000 we just moved before tax rates increase. And when you do that, you will have cleansed your money of taxes. You'll have reinvested it in a tax-free account. You won't have to take into account ever increasing amounts of income and ever higher tax rates, causing you to pay tax on Social Security and Medicare premiums. So here's my question for you. Do you have a strategic tax plan that caused you to take money out of your retirement account and fill out your tax bracket at the lower rates in 2018, 2019, 2020, 2021, 2022? That's 5 years of moving money. Do you have a plan to do that? And if the answer is no, why not? Who's in charge of this? Is it your financial advisor? Well, where is he? Where is she on this particular issue? Are they asleep? Did they mention it to you? What about your CPA? Where are they? Did they even bring it up? And the astonishing thing that I run into, Patrice, is sometimes people will tell me about their CPA saying, oh, but all the taxes you're going to have to pay. So they kind of dissuade the person from doing this. What I want to say is they're absolutely right. Oh, all the taxes you're eventually going to have to pay. It's only getting larger. You see, the problem with the tax compliance people, the people who do tax returns, is they've got on blinders and they only see this year. And they think if they reduce taxes this year, they did you a great favor, not realizing that they're just setting you up to fail horribly. In 5 or 10 years from now, they're not being proactive tax planners. And if that's the kind of person you got doing your taxes, if that's the kind of person you got giving you financial advice, then maybe it's time you had an advisor that focuses on taxes, because tax is going to be one of your greatest expenses, probably your greatest expense in retirement. So what I want to say to you is be sure that you don't miss another year, because this can mean tens of thousands of additional dollars in your retirement accounts. For many of our listeners, Patrice, it can be hundreds of thousands more dollars. You must act on this now. We've got 3 years left. There's still time in 2023 to get this fixed. Plus, you've got 24 and 25. On January 1, 2026, tax rates are going right back where they were before the 2017 tax cuts. So I urge you to act on this while you still can. And if you need help, just call our office and we'll help you. You can find information on how to contact us by going to savingyouTaxes.com. You see, I knew you're driving down the road and you can't write and drive safely. So I thought I'd give you something that was easy to remember. Saving You Taxes. Say it out loud. savingyouTaxes.com. Say it again. savingyouTaxes.com. And when you go there, you'll find a phone number or a contact form. You can complete that form. You can reach out and touch our team, and our team will schedule a time for you to talk with me personally. People are always surprised. They're like, well, I didn't expect to get to talk to you. Yeah, I'm the one you get to talk to. At least most of the time. We're busy enough, frankly, these days. I may have to change that at some point and let some other people take those calls. But I love the people who listen to our show. People like Mark and Deb Ophoven, who were just in my office the other day, And just out of the clear blue sky, they said, hey, we love your podcast. We listen to it when we're driving all the time. And hopefully, as they're driving down the road right now, going to wherever they're going, they're hearing me talk about them. I love them. They are wonderful, wonderful, wonderful friends of mine and wonderful clients as well. And we enjoy them so much. So they're sharing the podcast, Patrice. In fact, we have a wonderful client who we've never met personally, only met her and her husband through Zoom on video conference. And the reason they became our client is they happened to hear this lady grumbling about taxes when they were out of state, off up in the north part of the world. They heard her grumbling about taxes and they said, you need to know our guy. And they gave her my name, and she called and said, the Ophovens told me to call you. How can you help me? And she became our client. She's a wonderful client. I love how this works. It's a wonderful opportunity to talk to and help people across the country. I had a guy call me the other day. His name was Jorge, and I can't remember his last name. It started with a D, I think. It was a Hispanic kind of name. He's from San Diego. And Jorge is in the pool cleaning business in San Diego. He's got a group of employees who go all over San Diego keeping pools clean. Jorge, if you're listening to the show, thanks so much. I enjoyed talking with you the other day. So we want to help people like the Ophovens and like Jorge. We want to help you. And if you'll reach out to us at savingyoutaxes.com, we'll make that happen. We'll do everything we can to move heaven and earth and move the tax code in your direction and bring you some benefit. Well, Patrice, I'm out of time and out of breath. That's it for our show today. Is there anything you want to remind the folks about before we call it a day?
Of course there is. Remember that free retirement toolkit. Go to wattswealth.com, download it there, transform your worries about retirement into confidence. That is the retirement toolkit. It's free, and you can get it at wattswealth.com. Once again, WATTSWEALTH.com.
That is awesome. I hope that you'll do that. The website again is what, Patrice?
wattswealth.com.
Awesome. Until next time, I'm J. Barry Watts, tax strategist and retirement planner, founder of the Wealth Care Corporation, host of the radio program Watts on Wealth, and host of The Truth About Taxes and Retirement, reminding you that when preparing for retirement, if you don't get the taxes right, nothing else matters.
Thank you for listening to The Truth About Taxes and Retirement podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of SavingYouTaxes.com. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional tax and investment advice. Always seek the advice of your own qualified advisor with any questions you may have regarding taxes and investing.